investors who are invested in publicly traded REITs that are, correlated and tied to the stock market, they've seen, losses this year. The values of those REITs have gone down, anywhere from, 9 to 13%. But then all the unlisted REITs, the B REIT, for example, which is like a $69 billion REIT. I mean, I believe it's the largest unlisted REIT in the world. They reported a growth of 9% over the same period. And so we've got there's investors who are saying, what is the difference here? Why is this up 9? This is down 13. If you're really buying the same types of assets. And then so there's a little bit of an arbitrage play. People saying I'm going to lock in my profits because in the private markets, they're not necessarily moving the valuations of these assets because there's a lot of price discovery going on right now. How do you value all the assets? What is the cap rate? Yeah. So it's an interesting question. There's positive and negatives to public and private markets. And it's interesting just to see the intersection. It's also a major factor of liquidity. One of the major advantages of public markets like the stock market is they're liquid markets. You can buy and sell in an instant. You don't need to, fill out a form and put a request in. Or a lot of private securities, alternative investments, most real estate, it's completely liquid. There's no redemption. Yeah. You're in it for the hold period. We're in this together. Yeah. That's the intention, and that's what a lot of investors like. They like actually the security and having that locked up, but it is a little bit inflexible compared to just having a phone and pressing a button and selling. Yeah. So different investor preferences. So we got a couple. It's talk of the town.
Yeah, I am wondering too, what is different about the way, because it is different, the B REIT is set up different than maybe a publicly traded REIT, but then it's also has some features that make it very similar to a publicly traded REIT. And then but then there's also this idea of like, how do they get the 9% when other ones don't? Like, is there something that they're doing that is not as open and is acting as kind of a filter between the actual price of their assets and their performance of the B REIT?
Well, I think it's more of the public markets. The value of those shares are traded on the public market. At every given second, a new investor can make their determination of the price and buy or sell, whether they feel like that price is a good value, fair value. Yeah. Whereas on unlisted REIT, there is no publicly, you're not trading it publicly. To get out, you have to fill out a form and an application, and they can only redeem so much during a given month, and that's really that's been the issue, and that's the headline, is that they've run into these limits of how much that they can return and give in a month and in a quarter, and it's relative to the net asset value of the fund. So, for example, in BlackRock's B REIT, they have a provision in their partnership documents and their operating agreement that limits redemptions up to 5% of the net asset value of the entire fund. Yeah. And so it's not as though BlackRock has said, we're in dire straits, we've got problems, we're going to hold off on redemptions. It's just baked into their operating agreement of, hey, we're only going to allow X amount of redemptions on a given month or a given quarter, because otherwise, if everyone said, hey, we're going to get out right now because we think the value is so high and we want to sell at these high prices, well, one, you have to have a seller, but they are, I believe, selling it relative to the net asset value. But still, whether BlackRock's buying it back or if you're selling it to other potential investors, but they have to have enough liquidity, BlackRock does, to fulfill these obligations. And they've got a lot of cash on hand. They're always handling some amount of redemptions, but they don't want to start selling off assets right now when it's not a great time to sell, only to meet redemption requests. Okay. And so I think that's the hard part, that not only B REIT, but Starwood, that's doing the same thing, and many of other funds that are perpetual in nature, or some of them, or you can have an interval fund, which allows for a certain degree of liquidity, because the one aspect of a lot of privately traded senior securities that some investors don't like, as we were just talking about, is the illiquidity. They're illiquid investments. You can't get out. And so vehicles like BREIT and Starwood and other perpetual and interval funds, to try to solve for that illiquidity problem, they've allowed for a certain amount of redemptions. And so the unique features of these investment vehicles are, and it's not getting them into trouble, but it's not a good look or headline when people are running for the exits. And they're running for the exits because the value's so high. You know, so they're saying, I'm seeing, again, these other publicly traded REITs are buying the same stuff, losing value. You just haven't reset your values yet, is what they're assuming.
Yeah.
And so, like, I'd rather lock in my prices at, 2021 pricing or valuations or whenever they've done their revaluation, which I assume is on a monthly or quarterly basis. But again, it comes back to price discovery. What is the price of everything? That's where
it confuses me, is how they get their prices, and what are they doing something or they're not doing something where it's making it where it's causing this. I thought the number was that publicly traded REITs were almost like 20% down, and then they're 10% up. So we're in the middle of that 30% gap is the truth.
Yeah. Well, and I mean, if you talk to most brokers right now, most people in commercial real estate, they'll tell you that the prices are down.
Yeah.
10, 15%, 20%. So how can the net asset value be up?
Yeah.
If the rest of the valuations or the pricing is down. Yeah. Now, pricing is, again, it's relative to income. So, your cap rates can expand, but your incomes can increase. But that's a lot of growth that you need to maintain that same amount of value.
Yeah.
Now, if like a lot of our investments, because immediately what you think of as like a multifamily investor, if you're investing in more your typical like syndication or like a fund like the Gray Fund, first thing you think about is like, oh man, I've made these investments, they've gone down in value. But as a investor in a private investment, you really don't realize any of that loss until you actually sell. Your gain or loss happens when you actually dispose of the asset or you're receiving distributions. And there's periods where you kind of don't know. I mean, for an example, it was back in 2020 during COVID. After March, people did not know where things were going, and there was all this talk of markets crashing, including commercial real estate, because everyone was going to stop working, stop going to jobs, restaurants were closing, retail was closing. Not certain if people would be able to cover their leases, including apartment leases. I mean, everyone had just been laid off. Everyone just like lost their job because no one could do anything. So there was uncertainty that there was no transaction activity going on.
Yeah.
So there's not really any price discovery. But if you had to ask someone, took a survey, the price would be pretty low. But we didn't sell then. So it's like, did that happen? It's kind of like tree falls in the forest.
Yeah.
If no one hears it, did it actually make a sound? Well, it did. It does make a sound, but if you don't hear it, it doesn't really matter.
And if you're on the right time period, another tree grew in its place.
Yeah.
So
exactly.
Your net trees are fine.
Net neutral, or at least carbon neutral. So it's this interesting situation of where you can't ignore where prices are, obviously, especially when you're looking to buy new assets, and you want to know relatively what everything is worth. It's good information to know.
Yeah.
Because you may take an action on it. Typically, when the price is low, it's not like, oh, let's sell now. That's again where BlackRock is in, because they're like, well, we don't want to redeem too much more because then we're going to have to sell. Prices are lower, and then, by the way, they'll really have to start relooking at their valuations of all their assets.
Yeah, that's the most interesting thing. Is I'd love to know. Yeah, because it just seems like there is something different between how maybe these public REITs are responding to the prices than a private REIT, and maybe that gives them cushion in some situations, but it does seem like the way they've structured it, it makes it a little more precarious.
Yeah,
but
well, like the REITs, like other stocks are forward-looking indicators, and they're pricing in things that are 6 months in the future. That's why you saw like home builders and REITs took most of their losses earlier in the year, and then you've actually seen some REITs and home builders come back in the last month or so and actually post some pretty nice gains, thinking that maybe these interest rate hikes are starting to slow down, not be as aggressive, and seeing kind of a bright side on the other the next 6 months to a year. The markets may change their mind tomorrow, but so again, that's a difference. But with that market activity, it gives it that kind of a looking glass into the future.
Yeah.
But on non-traded REITs, again, they're not traded, so you don't have that type of market information and that type of forward-looking indicators on a unlisted REIT. But again, that's where the intersection is. People are looking at publicly traded REITs and non-traded REITs, and they're seeing a huge difference.
Yeah.
In general, though, when you look at returns, people confuse REITs with buying real estate. Now, REITs are certainly associated with real estate. They're real estate investment trusts. They're companies that they go out there and they buy and often manage the real estate. But as a shareholder of a REIT, you are not a owner of real estate. You are a shareholder in a company that is in the business of buying real estate. And then you get a dividend for being a shareholder of that REIT. But it's not the same. And so when you look at the return profiles of REITs versus private real estate, especially in environments like this, in a stagflationary environment or in a recession, the private real estate almost always significantly outperforms a publicly traded REIT. Publicly traded REITs more act like a short-long bond over time, and that may be the objective that an investor is going to go for, but it's not typically all of the attributes or reason why someone would want to invest in real estate.
Yeah.
And that's where syndications and like a fund like the Gray Fund that's open to accredited investors only, provides some insulation to public market volatility.
Yeah.
That's one of the reasons why people do it. They don't have to worry about what the market's going to say tomorrow, because it's like, well, we're going to sell it in 5 years. I care about what the price is in 5 years, not today necessarily.
Yeah.
I would like to know, but
It is that is the most interesting thing is how much you open it up. You're making it more convenient for investors.
Yeah.
But you're opening up to a lot more risk.
Well, it's definitely a problem to solve, and it is a good solution. It's just in events like this that are dynamic, that some of these solutions and mechanisms can start to, and it's not. I was going to say start to break, but it's not breaking. It's actually working pretty well.
Yeah.
They've put these limits in for a reason of saying, it's just because they can't facilitate unlimited liquidity doesn't mean it's wrong.
Yeah.
And it doesn't necessarily mean that commercial real estate isn't a bad place. But so, the underlying takeaway here is that I think the headlines may be running the narrative in a more negative fashion than the reality is.